Okay, let's dive into this. Welcome to today's explainer. Look, if you've been staring at the markets recently and just totally scratching your head, believe me, you are not alone. The economic landscape of Q2 2026 has introduced this deeply confusing, almost contradictory environment. We're seeing massive, sweeping policy shifts colliding head-on with unprecedented corporate pivots. So our goal today is actually pretty simple. We're going to navigate this new ambiguity together, relying on the actual data and trends that are clearly mapped out right in front of us. Here's our roadmap for finding that clarity today. We're going to kick things off with the new era of ambiguity and geopolitics. Then we'll move into the fragmented consumer, corporate AI moonshots, unlocking asset value, and we'll wrap up with preparing for volatility. To really make sense of all this, we're going to build a sort of funnel today. We'll start way up high with these massive, abstract global forces and filter right down into everyday, relatable micro-business stories. Because right now, the overarching tension of the entire market is basically a massive tug of war. Pulling on one side, we've got these incredibly bullish catalysts, right? We're talking geopolitical relief with oil dropping below $80 a barrel, active political support with President Trump practically cheering on the market, and a surprisingly rock-solid economic foundation. But pulling really hard in the total opposite direction are the bearish pressures. We have the stark reality of higher-for-longer interest rates causing broad equities, especially in the tech sector, to sell off as the Fed shifts hawkish. It is a market that's just desperately looking for a direction. Let's start with Section 1, the new era of ambiguity. The Fed goes dark. So, we're officially entering a brand new era, largely because the Federal Reserve has suddenly, and very deliberately, gone completely dark. And this brilliantly illustrates the shift. Think about it. For the past decade, we basically lived in this cozy era of high forward guidance. The Fed literally held the market's hand. Paths were super predictable, consensus was heavy, and volatility was actively suppressed. But now, under Chairman Warsh, we are right back to a Greenspan-style era. The stance is minimalist, it's opaque. They're actually calling it constructive ambiguity. The Fed is prioritizing action over explanation, and most importantly, volatility is now just accepted as a natural market function. The handholding is officially over, folks. But here is where things get highly complex. Chairman Warsh himself might be playing it quiet, but wow, the committee around him is incredibly loud. Check out this alarming divergence on the dot plot. 9 out of 18 policymakers are now projecting higher rates by year-end 2026, pushing the median terminal rate projection up to 3.8%. And keep in mind, back in March, 0 members saw a rate hike coming. So why this sudden panic? Just look at that CPI activation curve at the bottom. We've got an aggressive inflation trend that hit 4.2% in May. If inflation doesn't retreat to that magical 2% target, analysts are warning a hike could trigger as soon as September. Moving on to Section 2, Geopolitics and Global Energy, this 60-day countdown. Okay, so the Fed is a wild card right now. That brings us to our second macro pillar, an incredibly fragile geopolitical truce that's currently dictating global energy prices. What you're seeing here is peace on paper. It's a 14-point memorandum of understanding in the Middle East, heavily backed by President Trump to avoid what could have been an absolute economic catastrophe. The terms are huge. We're talking a permanent end to the war, lifting the U.S. naval blockade, Iran pledging never to produce nuclear weapons, and shipping traffic resuming to full capacity. This deal is exactly what drove crude oil plummeting down below $80. But as RBC Capital Markets rightly points out, lifting those sanctions still faces really tight congressional oversight. It's a very delicate balance. And that delicate balance is tied to a ticking clock. Let's quickly walk through this 60-day countdown for global energy, because it's crucial. Day 1, the Strait opens toll-free. Great. But the suspense really builds toward day 61. That is our divergence point. If a toll-free extension happens, the free flow of oil continues, and the IEA actually forecasts a massive global oil glut by 2027. But if tolls are imposed, Western shippers are going to balk, the flow of oil gets heavily restricted, and we're looking at a major upward price shock. Now, President Trump claimed the extension will hold, but later acknowledged it isn't legally specified in the agreement itself. And when you consider that the U.S. Strategic Petroleum Reserve is sitting at its lowest level since the 1980s, the stakes on day 61 literally could not be higher. Let's funnel down to Section 3, the fragmented consumer economy, the barbell effect. All right, let's pivot. We've just looked at all this high-stakes global ambiguity, so let's zoom in to the micro level to see where the real clarity and honestly the real solutions actually lie. The single most striking takeaway right now is that the foundational American consumer, they just keep spending. Despite persistent inflation and all the macro noise we just went through, look at these dials. Retail spending surged 0.9% in May, which is a significant acceleration from April. And the housing market? Pending home sales leaped 3.8% month over month. That completely crushed economists' expectations of just 1% growth. The everyday consumer is showing absolutely massive resilience.
But the real question is, how are they spending that money? Because consumer spending isn't collapsing, it's fragmenting. Welcome to the barbell economy. Now, what's really interesting about this slide is the curve itself. Consumers are entirely fleeing the middle. They are rushing straight to the extremes. On one side, you have hypervalue. These are consumers demanding bundled deals and clear, unquestionable affordability. On the exact opposite side, you have the premium experience. People who are perfectly willing to pay higher prices as long as the portion size and the atmosphere justify it. Bottom line, if your business is stuck in that squeezed middle right now, offering neither deep discounts nor premium experiences, you are rapidly bleeding market share.
Let's ground this abstract curve into reality for a second. Just look at the winners and losers here. Over in the hyper-value category, Taco Bell sales are up a whopping 8%, and McDonald's is up 3.9%, largely driven by their sub-$3 menus. On the premium side, Texas Roadhouse is winning big, up 7.1%, perfectly capturing that high-end consumer engagement. But then, look at the losers. The pizza category has basically been labeled the biggest loser of 2026. It's caught right in that squeezed middle as health-conscious diners abandon shareable carbs. It's actually gotten so bad that Yum Brands is actively selling off struggling Pizza Hut. Like I said, you have to pick a side of the barbell to survive.
Section 4. Corporate AI Moonshots, the ultimate pivot.
So, what do you do when your corporation is trapped in that squeezed middle, facing total irrelevance? You pull off a bizarre transformation. Just read this quote: "It is probably better to be an AI moonshot than a failing shoe company in 2026. This is the crazy story of Allbirds, a struggling footwear retailer. They literally sold off their legacy shoe brand for a mere $39 million and completely rebranded as Smartbird, an AI data center operator. I know, it sounds insane, but the craziest part? The market absolutely loved it. Their stock immediately jumped 39% the second they completed the pivot. But how on earth does a shoe company actually compete in an extremely capital-intensive AI arena against multi-billion-dollar giants like CoreWeave? Well, here are the mechanics of their strategy. Step 1. Client focus. They're entirely targeting mid-market clients who are currently locked out of the mega clouds. Step 2. Hardware design. They're deploying bespoke chip clusters built precisely to customer specifications just to keep their overhead down. And step 3, capital fuel. They funded this massive build-out by doubling their convertible bond offering from $50 million up to $100 million. It's an absurd moonshot for sure, but it is a perfect example of how desperate companies are adapting to a fragmented, ambiguous world. Section 5. Unlocking Hidden Asset Value, the MSG Rally.
You know, sometimes you don't even need to pivot to AI to survive. Sometimes incredible value is just hiding in plain sight, waiting for the exact right catalyst to unlock it. I want you to just look at this number, $13.75 billion. For years, Wall Street was completely discounting the true underlying internal valuation of a highly recognizable public company. But beneath the surface, that massive sum was exactly what their core assets were actually worth. We are talking about Madison Square Garden Sports. As recently as September 2025, this entire public company traded at a stark discount of just $5.3 billion. But then the ultimate catalyst arrived. The New York Knicks won their first NBA championship in 52 years, just completely dominating the playoffs. That sentiment reversal was explosive. For years, the stock had been punished by what people called the Dolan discount. Now, as Ariel Investments notes, that has literally morphed into the Dolan premium. The true asset value of the Knicks and Rangers, that $13.75 billion we just saw, was finally recognized by the market, sending MSG Sports stock up nearly 100%, a real game changer. And finally, Section 6, Preparing for Market Volatility, the Path Forward. So how do we synthesize all of this? We've funneled down from a completely dark Federal Reserve and ticking geopolitical clocks all the way down to the clear realities of fast food barbells, AI shoe companies, and basketball championships. It all leads to this final executive takeaway. With Chairman Warsh permanently darkening the Fed's forward guidance, we no longer have a macro safety net. That means incoming micro data points are going to cause outsized, entirely unpredictable market reactions. Just look at the calendar here.
A seemingly standard Thursday now holds massive weight. Kroger earnings are going to serve as a critical check on grocery spending against that restaurant data we saw earlier. Initial jobless claims are going to severely test the Fed's new productivity mandate. Without the Fed holding our hand and telling us what to think, the market is going to overreact to all of this. Which leaves us with this final thought. In a market strictly defined by macro ambiguity, but total micro clarity, are you positioned to survive the incoming structural volatility? The hand-holding is over. But as we've seen through all these slides today, if you know where to look, if you can spot those fragmented consumer trends, the bold corporate pivots, and the hidden asset values, you can find immense clarity while the rest of the market is just flying blind. Thank you so much for joining me on this explainer today. And remember, keep your eyes on the data.